So here we go. Why the housing market should brace for double-digit mortgage rates in 2023. Well, they're close. They're already close. We're at 7.3% now. Now, just so you know, double-digit mortgage rates, will they crush? Well, I mean, it's just going to crush it even more. And you say, well, you know, how tied into the economy is housing? Well, I think it's a pretty big part. I think it's a pretty big part. All right, here we go. Even if Federal Reserve Chairman Jerome Powell and his cohorts stopped hiking policy rates soon, the 30-year fixed would still climb to 10%, according to Christopher Whalen, chairman of Whalen Global Advisors. That's because the Fed's torrid rates of rate increases in 2022 takes time to seep back into mortgage rates, especially with the Fed funds rate already jumping to a 3 to 3.25% range in late September, almost a year before, from almost zero. Lenders only slowly adjust their rates. They're not used to seeing rates move this fast and typically would change rates only once a month or once every other month. I don't know if that's true. It's the rate of change that's so ridiculous. Borrowers pay a premium above risk-free treasury rates on mortgages to help account for default risk. The 30-year treasury rate rose to 4.213% Thursday, its highest since 2011. Freddie Mac on Thursday said the 30-year fixed mortgage rate was averaging 6.94%. Remember, I was telling you that on that when we first looked at it that it would be above 7 if it continues for this week. A 20-year high that has severely curtailed demand for new home loans. But with U.S. inflation showing no signs of a clear pullback from a 40-year high, expectations have been running high for the Fed to increase its policy rate by another 75 basis points at its November meeting and potentially the same amount again in December. Now, my understanding is that they've already said they're going to raise rates 75 basis points. And then they're going to take a wait-and-see approach after that, which caused the markets to rally late in the week last week. I don't know if that's true. It says CME odds on Thursday favored a 4.75 to 5% Fed funds raise to kick off February. There's a lag in effect in mortgages, adding that even if central bankers decided to hit pause on additional rate increases after their December meeting, the 30-year mortgage rate still would easily touch 10% by February. Whalen, an investment banker, author, and specialist focused on banking and mortgage finance, urged the U.S. Securities and Exchange Commission in 2008 to move complex and opaque derivatives back into the daylight after banks and investors saw hundreds of billions of dollars in losses tied to structured debt, including subprime mortgage exposure. He also provided testimony to Congress in 2009 about systemic risk of the banking industry. Now, Whalen sees another major shakeout coming in mortgage banking as profitability continues to get pinched and the housing market sputters. Here's this chart. Mortgage banking profits. Like when you could refinance, that was pretty good. Anyway, importantly, Whalen also sees potential for home prices to give back all their pandemic gains if rates stay high for all of 2023. I don't know about that. That's a bigger call than estimates for a 10 to 15% correction. But Whalen pointed out that expected home flipping volumes that reached almost 150 billion or 10% of total sales in 2022, and the cold blanket of double-digit mortgage rates is catalyst for the steeper home price retreat. I don't know. It says economists at Mizuho Securities on Thursday pegged median home sales prices as down 2.5% from their peak. In the client note, and characterizing the housing market as deteriorating, but mostly in line with expectations given the sharp jump in mortgage rates. See, they were coming in and saying that home prices early, like in January and February and March, they were saying that home prices were going to increase 6 to 7% this year. They meaning like all of them combined as an average. Mortgage loan rates can be traced directly to the mortgage-backed securities or MBS market, which are bonds that trade on Wall Street, mostly with government backing that finance the bulk of the nearly $13 trillion U.S. mortgage debt market. It will take us months to get the bond market and lending market in sync so people can make money again. I mean, it's not good. It's not good. I'm going to go back to this screen because I'm getting tired. Well, what do you think? You should probably put it in the comment section. You could probably put it in the chat. We don't have a lively chat tonight, that's for sure.